2025 was supposed to be the year of the massive Bitcoin breakout, but instead, price stalled, confidence cracked, and the 4-year cycle fear narrative took over. But what if 2025 wasn't a failure at all? What if it was the reset, and the real setup is pointing straight to 2026? Today, we're going to connect the dots between economic cycles, AI and energy, why Michael Saylor has been meeting quietly with the biggest banks in the world, and why Bitcoin's role in an AI-driven future goes far beyond money itself. Welcome to No Second Best, the show where conviction meets reality and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. Coming into 2025, the story felt obvious. Post-halving momentum, ETFs absorbing supply, institutions finally on board, and yet it didn't play out that way. Bitcoin didn't explode higher like everyone expected. The economy stayed sluggish, and a lot of people were left asking whether the entire thesis had broken down. To understand why, we need to zoom out, away from Bitcoin, and look at the economy itself. Jeff Ross is an investor and macro analyst who recently sat down on what Bitcoin did to talk about something most people still don't want to accept: that Bitcoin's old timing framework doesn't work anymore.
Everybody talks about Bitcoin moving according to what global liquidity is doing, but it also is very strongly correlated to what the global economy is doing, and especially what the US economy is doing. What I really did not expect to happen in 2025 was that the US economy would not get out of a recession. The manufacturing sector in the US has been literally in a recession since 2022. It spiked briefly, the ISM manufacturing PMI briefly spiked above 50. So basically it went from contraction to expansion briefly, I think in late 2024, early 2025, basically right after Trump was nominated. But then, of course, they came out with Doge and then followed that with tariff stuff, and that has just beaten down the economy. So besides that little blip where it went above 50, it's been in a contraction, or another word for that is a recession, since the end of 2022. I did not expect that at all. I thought that the manufacturing economy would be just booming by now, and that we'd actually be peaking and rolling over at this point. So people ask, I see people still asking this, is the 4-year cycle dead? And I'm like, of course it's dead. It's of course it is. Like, it's not even a question about it. Like, it died because the economy is not in this 4-year cycle anymore.
What Ross is really saying here isn't some edgy dismissal of the 4-year cycles. He's explaining why so many people felt whiplash this year. For over a decade, Bitcoin trained people to expect clean, time-based moves. The halving happens, liquidity follows, and then price reacts. That mental model worked until the economy stopped cooperating. The problem in 2025 wasn't that Bitcoin suddenly broke its own rules. The problem was that the manufacturing economy never reaccelerated the way it normally does at this stage. The inputs that used to line up simply didn't show up. So when people ask whether the 4-year cycle is dead, Ross isn't making a philosophical claim. He's saying the environment that allowed that pattern to repeat just isn't there anymore. And Ross doesn't stop there. He doesn't deny that 2025 has been painful. He agrees with it, but he frames it very differently.
But I think things look very good for a reversal of fortune. So just the way that 2025 surprised to the downside for the US economy, which is still in a contraction, and for Bitcoin, which is bearish, very strongly bearish right now. Although I think it's close to a bottom. I think it's at or near a bottom at these levels. I think 2026 is looking good, and I think that's because the One Big Beautiful Bill Act will finally basically start taking effect. I think the accounting rules that are going to be in place starting in 2026 are going to start taking an effect, and I think people shouldn't underestimate how strong that impact will be. So I've basically, yes, I'm bearish currently, and I flipped to now being, instead of bearish for 2026, I'm actually quite bullish and constructive on 2026. With one more caveat, and then I'll stop, is that I think I wouldn't get too excited about the price of Bitcoin until you start seeing signs that the US economy is starting to take off again. So I closely watch the ISM manufacturing PMI, and it's still, the latest thing just came out recently, and new orders are actually down again. So still very contractionary, still in a recession, basically. Until you see new orders start to peak up above 50 and then rise higher, and then finally the ISM manufacturing PMI itself start to rise above 50 to 55 and head towards 60, that will be the point that we'll start seeing Bitcoin making tremendous moves higher. But until then, I would definitely temper expectations.
This is where I think Ross is directionally right, but not complete. He's absolutely correct that over the last couple of years, Bitcoin has been far more sensitive to real economic momentum than people expected. When manufacturing stays stuck in contraction and capital stays defensive, it's hard for Bitcoin to just power higher on narrative alone. But that doesn't mean Bitcoin is permanently bound to those signals. It means that in the absence of a major catalyst, macro conditions tend to dominate. And that distinction matters because history shows Bitcoin doesn't need perfect economic alignment to move. It needs a structural shift that changes how capital can interact with it. That's what makes this next phase so interesting. Ross is describing the baseline environment, what happens without a catalyst. The real question is whether something emerges that allows Bitcoin to decouple, not from the economy, but from the timing of traditional economic signals. And that's exactly where the conversation around banks, credit, AI, and energy starts to take over. There's no question that there's a growing fear right now that AI is just another bubble. Too much hype, too much capital, not enough real demand. And that fear has been weighing on markets more than people realize. But in a recent video, macro investor Jordy Visser makes a different argument. We'll link that full video in the description below. Visser's point isn't about hype versus reality, it's about transmission. Big technological shifts don't express themselves first through headlines or consumer-facing products. They express themselves through capital spending, infrastructure build-out, and energy demand. AI doesn't move the needle because someone's releasing a new demo or app. It moves the needle when companies start building data centers, upgrading factories, deploying automation, and pouring real capital into physical systems. That process is slow at the front end, but once it turns, it shows up everywhere and all at once. So when people look at the economy today and say, where's the impact? Visser's answer is simple. You're looking in the wrong place. The investment cycle is underway, but it hasn't finished translating into growth yet. And that's why 2026 keeps coming up. Not because AI suddenly becomes real then, but because that's when the physical, energy-intensive side of the transition starts to dominate. If 2025 felt disappointing on price, it definitely wasn't disappointing under the hood. And no one has been more explicit about that than Michael Saylor. This next clip comes from Saylor's latest interview with Alex Thorne of Galaxy Research.
I think that the more important point is the last 12 months have been probably the best 12 months in the history of the industry in terms of fundamentals. And it's profound what's happened since December. Let's tick off the highlights of the last 12 months. You have a universally supportive administration, a supportive head of the SEC, supportive head of the CFTC, supportive head of the Treasury, supportive president, supportive vice president. You have David Sachs go out publicly and say coin is a digital commodity, it's digital gold, it's an asset without an issuer. We recognize its special nature in the world as a technology to propagate property rights and freedom. That happened in March of this year, right? People forget how that developed. We saw the spot Bitcoin ETFs get uncrippled. We had in-kind creates and redemptions. People can now swap their Bitcoin for IBIT type shares and borrow against them and then swap back. That was a big deal. We saw the onshore derivatives market for IBIT get uncrippled. It went from nothing to 10 billion. And then when they actually took the cuffs off, it went to 50 billion. That's a big deal. We saw guidance from the CFTC just last week. You can now trade spot crypto assets like Bitcoin on regulated commodities exchanges in the US. You'll see them start trading on the CME. We saw guidance that you could start to use Bitcoin as collateral, right? Crypto assets collateral against those derivatives contracts and trading contracts. That's a big deal. We just saw guidance from the SEC that it's possible for the DTC to tokenize their entire security portfolio. We're talking all the securities in the world moving on the DTC. And the fact that guidance came from the SEC was a big deal. But the fact that the CEO of the DTC got on X and put out a video saying they're enthusiastic about that was a big deal. We saw favorable guidance come out of the IRS and Treasury that made the entire issue of unrealized capital gains tax on crypto assets go away. That's a big deal. We also saw the creation of the digital credit market. My company, we did 5 IPOs of digital credit instruments, and that entire market went from nothing to $8 billion in 10 months. And we're pioneering this public digital credit market, but We also saw now an avalanche of conventional banks. We saw guidance, positive guidance from the OCC and the FDIC probably every 2 months for the year, like 6 salvos. And after the 6th salvo, we started to see the entire dam breaking and the banking industry thaw. And now, off the top of my head, I think we've seen pro-digital assets, pro-crypto, pro-Bitcoin announcements from Citi, Charles Schwab. Both have announced they're going to custody and extend credit on Bitcoin in the coming 6 months. We saw positive announcements from JP Morgan. We saw positive announcements from Bank of America. We saw positive activity from BNY Mellon. We saw Standard Chartered Bank and PNC Bank both announce agreements with Coinbase, taking advantage of their crypto as a service to custody and handle and trade Bitcoin. Oh, and I left out the other obvious thing, which is we got fair value accounting.
Yeah.
It was impossible to recognize a gain in a digital and asset investment until the year 2025. And I guess beyond that, I guess I would be remiss not to note that I guess 200 publicly traded companies put crypto assets of some sort on their balance sheet this year.
Yep.
And we went to 200 companies that have Bitcoin on their balance sheet. And I guess last point, my company I think we raised $23 or $24 billion this year.
Yeah. I think you bought more Bitcoin this year than any year.
Yeah. No, and so I think if I was looking at the industry fundamentals, I would say it's exceeded my expectations at a fundamental level across the board. We couldn't have a more favorable setup for global adoption and institutional adoption of digital assets in general.
This is where a lot of people lost the plot over the past year. If you focus only on price, 2025 felt like stagnation. But if you zoom out and look at what actually changed, regulation, accounting rules, custody, derivatives, credit markets, it's hard to argue that this was a weak year. What Saylor is describing is Bitcoin becoming usable by institutions that simply couldn't touch it before. That kind of groundwork doesn't show up immediately in price. It shows up later when capital finally has permission to move. Over the past few months, Saylor and Strategy CEO Phong Le have been quietly meeting with major banks, JP Morgan, Morgan Stanley, and countless others across the world, not to pitch Bitcoin, but to build credit products on top of it. This is where the conversation shifts from ETFs to something much, much bigger.
What will be the catalyst then for next year with such a good setup? Is it just a matter of working through some of those, like you were talking about the free market, some of those OG sellers, or markets take time to change their tune? What's going to take us higher?
I think the drivers would be, my checklist would be, you watch the derivatives market and the way it forms, and that's the offshore derivatives market, the crypto native derivatives market, perpetuals, 20x perpetuals, that forming onshore, that's a big deal. Cross margin, Bitcoin is collateral against derivatives in the United States on regulated exchange will be a big deal. So the formation of the commodities markets and the derivatives market and how we integrate regulated markets with offshore markets, I think that'll be a driver. I think the second driver will be the formation of the bank credit networks. When Bitcoin's 90,000 a coin and you're selling 450 coins a day into the market, that's $40 million of natural supply. And you worked it out, and it's 16 billion a year or something of supply available from the miners. So $16 billion is a year's supply. Every time a bank creates $16 billion of credit, that's 1 year's supply taken out of circulation. So we're now getting to the point where banks like Citi and Bank of America and JP Morgan and Wells Fargo or Schwab, any of those can create that entire $16 billion worth of credit in 12 months. So you're watching the formation of major credit networks, and you're looking at a $2 trillion asset class that's been unbanked. And so as you watch the formation of banking credit and corporate credit instruments on top of that asset class, that's going to be a big driver.
And this is the part that still isn't fully registering in most people. ETFs were important, but they're passive. They absorb supply, but they don't create leverage inside the financial system. Bank credit does. What Saylor is describing is the moment Bitcoin stops being something banks merely custody and starts becoming something they actively build financial products on top of. Once that happens, demand isn't driven by narratives or flows, it's driven by balance sheets. And that's a very different phase of adoption than anything Bitcoin has experienced before. And this shift from speculative demand to balance sheet demand is exactly where long-term strategy starts to matter. If you're thinking about Bitcoin beyond the next quarter, Swan Private is built for that kind of mindset. It's a dedicated team that works directly with families and businesses who want to allocate to Bitcoin thoughtfully, with proper custody, long-term planning, and an understanding of how Bitcoin fits into a broader financial picture. This isn't about chasing price moves or timing the market. It's about building conviction, managing risk, and structuring ownership that actually holds up over generations. If that sounds like how you're thinking about Bitcoin, you can learn more about Swan Private at swan.com/nosecondbest. Now, I want to close with something that goes much deeper than price and economic cycles and far beyond 2026. We're going to put up a post on screen from Jason Lowery. Now, Lowery is a US Space Force officer and the author of Soft War. And he's been thinking deeply about how power, security, and conflict change in a world shaped by computation. This section is based on this post that he shared, and while his language can get technical, the core idea underneath it is both simple and profound, especially when you start thinking about Bitcoin in an AI-driven world. Here's the problem that Lowery's pointing at. AI is driving the cost of intelligence towards zero. Reasoning, pattern recognition, simulation, all of it is becoming cheap, fast, and abundant. And when intelligence becomes abundant, something dangerous happens. Every system that relies purely on logic, permissions, rules, or signals becomes vulnerable. Because an AI doesn't need to break the rules, it can simply overwhelm them. It can simulate faster than humans can verify. It can generate more output than systems were designed to absorb. That's the end state of collapsing computational cost. So the question becomes, how do you defend systems in a world where intelligence itself is no longer scarce? And this is where Bitcoin stops being just money. Bitcoin doesn't secure its network with rules or permissions, it secures it with proof of work, with energy, hardware, and time. Every block represents real-world cost that can't be simulated, shortcut, or faked. Proof of work forces computation to collide with physical reality. Electricity has to be burned, machines have to exist, energy has to be sourced, time has to pass. An AI can outthink rules, but it can't outthink physics. And what Bitcoin does, almost accidentally, is turn that physical cost into a globally verifiable signal, a way to measure price and enforce reality itself in a digital system. That's why Lowery argues Bitcoin becomes more important because of AI, not in spite of it. In a world where intelligence is cheap, what becomes scarce isn't ideas or output, it's verification, finality, coordination under adversarial conditions, knowing that something actually happened at a real cost in the real world. Bitcoin solves that by anchoring digital systems to energy and work. So when we say Bitcoin is digital gold, we're not wrong, but we're barely scratching the surface. Gold stored value in a world where trust was scarce. Bitcoin enforces reality in a world where intelligence is cheap. That's why this matters beyond finance, beyond markets, and beyond 2026. AI and Bitcoin aren't opposing forces, they're complementary systems. One collapses the cost of intelligence, the other enforces the cost of reality. And if we're heading into a world shaped by machines that can think faster than any human ever could, then the system that ties value, security, and coordination to physical cost doesn't become less important, it becomes essential. So when you step back and look at everything we've talked about today, a pattern starts to emerge. These aren't separate stories, they're layers of the same transition. 2026 matters in this context not because it's some magic year, but because it's where several slow-moving shifts start to overlap. Economic conditions begin to change, AI investment becomes physical instead of theoretical, and Bitcoin stops being something institutions observe from the sidelines and becomes something they actively build on top of. So when people focus only on short-term price action or debate whether Bitcoin kept up with some macro signal this year, they're often missing the bigger shift underway. Bitcoin is moving from a speculative asset to financial infrastructure to something even more fundamental in a world shaped by machines. And transitions like that don't necessarily announce themselves with clean breakouts. They unfold quietly until one day they're obvious in hindsight. I'm curious how you're thinking about all this. Do you see 2026 as a real turning point? What do you think about Strategy's partnership with the big banks? And how do you think Bitcoin fits into a world where AI changes the rules faster than anyone anticipates? Let us know in the comments. These are the conversations that actually move understanding forward. And if you enjoyed this episode, hit the like button and share it with someone who's still stuck watching short-term price moves. And don't forget to subscribe to the Swan Bitcoin channel for more high signal analysis like this. Thanks for watching. I hope you have a Merry Christmas. And remember, there is no second best money.